as well. When we look at risk of SMEs, it's not just the loss given default. You also look at the default rate of SMEs in the first place, because the losses, the loan provisions are the amount you set aside to assume that those loans are going to make a loss, effectively. So what are your losses on your loan portfolio? And that's your loan provisions. The loan provisions that you have to set aside. So if it's a big bank and they lend to SMEs, the default rate tends to be higher because, again, they're not doing expertise. They haven't got the expertise in house. They don't have local bankers on the ground visiting those local businesses, having a very close relationship with them and supporting them in the needs in the way that they need to be supported most. Whereas a community bank, because of the way it does banking, is much more relationship driven, it tends to have lower default rates on its loans. It's also a moral obligation, because if you're a small business and you've got a relationship with a small bank and you know that bank's there to help you and you know it's not there to try to make as much profits as possible, suck those profits out of the local economy and send it over shores to the shareholders or anything like that, you know the bank's there to support you. You take a loan from that bank. You also have a loan from HSBC, let's say, a big bank that you know if you repay them or don't, it doesn't really affect HSBC. But if you repay a small community bank or you don't repay a small community bank, it has a bigger impact on that community bank. You're morally more obligated, if you like, to repay the community bank loan because you know that community bank is there to do as much as it can to support you. You know it's going to have a worse impact on that community bank. Whereas HSBC or Lloyds or any of these big banks, there's not as much care. There's not as much moral obligation to repay it.
I don't think they need the moral obligation if they're over collateralized on the loan side. So the moral desire isn't there because they've extracted all the demands. The bank has extracted all the demands and put the onus onto the small medium sized enterprise business owners to say, look, not only are we looking to maximise our profits and we don't think your sector's that important and we prefer the kudos of giving loans to bigger companies, and if you do want a loan and we do want to give you some scraps, some of the crumbs of our loan department, we will, but we want to secure it on everything that you've worked for, because that just creates a dynamic where it's not based on a relationship. It's based on you're a number and we want to secure it in every possible way so that we can have our cake and eat it. Because the issue has always been that a loan is given out and there's a certain degree of risk. So when there's a risk element in terms of, well, we need to charge this interest rate because of the risk that some people might not pay back their loans. And that's always been the relationship with lending. And that is something that if you want to be a lender, that's a risk that you need to manage and a risk that you need to understand. And it seems to be that the small, medium-sized businesses are being disproportionately hit harder on the basis of in the bank's desires to secure the risk side of it. They're almost have went too far beyond what they should be asking for because they want to remove as much risk, asking for this over-collateralization.
Yes and no. I don't agree that over-collateralization is a bad thing, and I don't agree that personal guarantees are a bad thing. If I'm a small business owner and a bank said to me, you don't have enough collateral, you don't have enough security in your business for this loan, you can either put up a personal guarantee or not have a loan, I think most small business owners would say, I'd rather put up a personal guarantee.
Yeah, I mean, look at it from this point of view is that it's back to the situation of, right, what's community banks? Why is there a requirement? Right, well, it's similar to, well, if you mentioned earlier on that the reason that the default rate is different between the big loans that are given out and the smaller loans that are given to SMEs is that the SMEs are over collateralized. That points to the fact that these SMEs are being asked for a different set of criteria from the big boys.
But the loss given default.
They're not applying the rules equally across the board, which means that there's a privilege given to higher book, higher loans, larger businesses, and that privilege isn't being extended to small and medium-sized enterprises.
Yeah, so one of the reasons for that is if you're a big business, banks don't put as stringent loan confidence. So effectively, terms attached to the loan, they're not as strict for a big business as it is for a small business. And some reasons for that is because they don't want to lose a business. They don't want this big business who's looking at getting a 100 million loan to go to another bank. So they're not going to be as forcing on the confidence. That's one reason.
Mm-hmm.
Whereas an SME, they can be very, forceful. They can sort of put their weight on the table and say, well, look, you need us. We're the big guys. You're a small business. We'll just make loads of terms attached to this loan that really strangles you. They can do that because of the relationship dynamic. So you're correct. In terms of the collateral, though, like I said, for a big business, you're never going to get a personal guarantee. So it's not just because they are treating SMEs different to big businesses. There's also a reason why they wouldn't be able to do that anyway. It wouldn't make sense. But certainly they're not as collateralized when it comes to big businesses as small businesses.